All right, let's open up the history books. This day, July 22nd, 1944, the 3-week-long Bretton Woods Conference ended with an agreement by 45 nations for unprecedented multilateral economic cooperation, a crucial launching pad for the world's post-war financial prosperity. That conference, held at a somewhat dilapidated estate up in rural New Hampshire that had been mothballed for almost 2 years prior, would make history several times over, particularly for the United States, which leveraged its newfound military dominance into monetary dominance as well. Remember, the U.S. became the world's largest economy all the way back in the 1870s, yet the British pound remained the dominant currency for decades to come. Bretton Woods, it changed all that for good. While best known for creating the International Monetary Fund and the precursor to the World Bank, the conference's lasting legacy has to be the creation of an open, rules-based...
where they gathered to design a financial system strong enough to keep global trade alive once the war was over.
The meeting itself wasn't about choosing the strongest. For a while, the arrangement did exactly what it was supposed to do. International trade recovered, economies expanded, and the dollar became the currency businesses trusted without hesitation. But as the years passed, a quiet imbalance began to grow. The world needed more dollars to keep trade moving, yet every new dollar entering the global economy increased America's promise to exchange those dollars for gold. The gap kept widening. Foreign governments started holding far more dollars than the United States could realistically redeem. On paper, the system still looked stable. Behind the scenes, confidence was beginning to depend less on gold and more on the belief that America would always be able to keep its word. It was a belief that would soon face its biggest test. By the end of the 19th
finally made.
America needs a full-time president and a full-time Congress. particularly at this time with problems we face at home and abroad, to continue to fight through the months ahead for my personal vindication would almost totally absorb the time and attention of both the President and the Congress in a period when our entire focus should be on the great issues of peace abroad and prosperity without inflation at home.
President Richard Nixon appeared on national television with an announcement that stunned the financial world. From that moment onward, foreign governments could no longer exchange their dollars for American gold. The promise that had supported the international monetary system for nearly 3 decades was over. Economists expected panic. If the dollar was no longer commodity. Every barrel of oil sold in dollars created another chain reaction. Countries couldn't simply print US dollars whenever they needed them. They had to earn them through exports, borrow them from international markets, or exchange their own currencies for them. The more their economies grew, the greater their demand for dollars became. But those dollars rarely stayed idle. Central banks invested them in one place they considered both safe and liquid: US Treasury Bonds. In simple terms, countries buying dollars eventually began lending that money back to the United States. It created a cycle unlike anything the world had seen before. America supplied the currency the world needed, and the world helped finance America's growing debt in return. The dollar was no longer just facilitating global trade. It had quietly become the foundation, supporting the entire American financial system. As more countries stored their wealth in US Treasury bonds, Washington gained something far more valuable than borrowed money. It gained time, flexibility, and influence. Most governments have to think twice before spending beyond their limits because investors can lose confidence overnight. The United States operates under a very different reality. As long as the world continues treating treasury bonds as one of the safest financial assets available, global demand keeps flowing toward American debt. That demand gives the US government the ability to raise enormous amounts of money at costs many countries could never dream of. Roads, research, military spending, financial rescue packages, even during major crises, the system continues to function because the world keeps buying the very debt that helps finance it. And that was only one layer of the dollar's influence. Most people think the Federal
The Federal Reserve keeps the financial system moving, but it isn't the place where the world's money is invested. That role belongs to Wall Street. Pension funds, insurance companies, sovereign wealth funds, and global investment firms collectively manage trillions of dollars, and a significant portion of that capital flows through American financial markets. For investors, the attraction isn't just higher returns, it's liquidity. At almost any moment, enormous amounts of money can enter or leave U.S. markets without bringing the system to a halt. That level of confidence is difficult to replicate anywhere else. The deeper these markets became, the stronger the dollar's position became. It created a cycle where trust attracted capital, capital strengthened the markets, and stronger markets attracted even more trust. Before long, Wall Street had become far more than America's financial center. It had become one of the world's financial engines.
Even after understanding the